Welcome back. We're looking at an analysis report on Rigetti Computing's incredible 540% rally, asking if this is just temporary or the start of a real secular bull run.
And it's a solid piece of work.
It is. I especially like the inclusion of the risks to the bull run thesis. It gives the whole thing a lot of balance right from the start.
Agreed. The author has synthesized a lot of complex info here. But we have identified 3 areas where I think a little more depth could really elevate the impact for an investor.
Okay, so let's jump right in with the first one, which is the tech. That's really the heart of the long-term case here.
The analysis should provide a more explicit and, frankly, a more concrete definition of why that 50-plus qubit goal is the critical threshold.
Right. So the material notes Rigetti's on track for these systems in 2026, and that this is the point where, quantum computers start solving problems that classical supercomputers just can't touch.
It does, and that's a strong statement. But the argument is a little generalized. It sort of assumes the audience already gets the practical difference between, say, 100 qubits and 150.
And why that specific jump is the one that matters.
Exactly.
If 150 is the magic number, we need to know why. The connection between that number and the specific problems that stump supercomputers. It isn't fully established. It feels a bit arbitrary right now.
I see the challenge. It's easy to throw big numbers around in quantum, but to an investor, what does that jump from 100 to 150 actually unlock? How does that turn from a lab experiment into a real revenue-generating machine? That's the core of it. We need to ground this idea of an operational milestone in tangible results. To really make that next-gen tech scaling pillar solid, you have to connect the 150 qubit goal directly to industry-specific applications that only become possible at that scale.
So go beyond just saying drug discovery and actually detail the advantage?
Precisely. Frame that 150 qubit number in the context of specific algorithmic complexity. I mean, you can introduce use cases where the problem size just becomes completely intractable for a classical computer.
Can you give us a concrete example of what that might look like in the analysis report?
Sure. So instead of a general reference to chemistry, you could talk about simulating a specific molecular structure. Maybe something like an iron-sulfur cluster, which is key for nitrogen fixation.
Okay.
You can explain that classical computation for that kind of problem scales exponentially past the 100 qubit mark, but it becomes manageable right around that 150 qubit threshold.
I see. That provides concrete evidence that this threshold will be the catalyst for, say, quantum cloud services revenue to really accelerate. It turns the number 150 from just a tech spec into a key that unlocks a new market.
That makes the whole technical pillar so much more powerful. It's not just an improvement, it's a phase shift in the addressable market.
Exactly. And that specificity is what really validates the whole secular bull run idea.
Okay, so building on that, hitting those milestones, it all depends on funding. And that takes us right to the financial picture, where the analysis has these 2 data points that seem to be fighting each other. The argument structure can be strengthened by explicitly linking the massive $600 million cash war chest directly to mitigating those high valuation risks.
Right, so the report calls the $600 million financial fuel, which is a great term. It ensures R&D funding without dilution, huge plus. But then in the risk section, it points out the valuation is, 100 times sales?
And a Q3 revenue miss.
And to a skeptical investor, that just screams high-burn science project.
And that's the tension the analysis needs to resolve head-on. Right now, it presents the cash and the valuation risk as 2 separate things. It treats the $600 million as just fuel, and the 100x sales as just risk.
It misses the chance to connect them.
It misses the opportunity to articulate how that financial fortress justifies the extreme multiple.
I completely agree. You have to show that the strength is the antidote to the risk. If the stock is at 100 times sales, the market is pricing in a future that isn't here yet. So why shouldn't an investor worry that the $600 million is just, prolonging the inevitable?
That's the exact friction point. The suggestion is to restructure the argument. Use that $600 million cash pile as the primary defense against the revenue lag risk. It's not just fuel. It's buying time. It's the runway needed to get to that 2026 revenue ramp-up we just talked about.
So the cash is what lets the company evolve from a science project to that high-growth SaaS hardware hybrid that analysts are hoping for. It's an investment in getting to the future.
Exactly. We need to bake the cash position right into the valuation discussion, frame the stock price less as buying today's sales and more as buying R&D time that's protected by capital reserves.
And how do you make that concrete for the analysis report?
Use a direct comparison. State that in today's high interest rate world where other speculative tech companies are facing painful capital calls.
Or toxic dilution.
Right. This $600 million ensures the R&D runway for years. This is what fundamentally separates Rigetti's valuation from its peers. The analysis should basically say, The 100x sales multiple is justifiable because the $600 million cash position eliminates the dilution risk needed to get to 2026.
That turns the cash from just an asset on a balance sheet into a strategic weapon against short-term impatience from the market.
It elevates the whole discussion from simple accounting to capital strategy.
Okay, let's move to the market itself, the volatility. I mean, we're talking about a 540% rally. The analysis has to reconcile that with what's happening now.
The concluding verdict can be sharpened by more explicitly reconciling the extreme volatility of that rally, the surge to the $58 high, with the current narrative of base building around $28.
So the conclusion says the verdict is likely yes for the patient investor, and it sees this consolidation around $28 as a base building phase. It also correctly points to reclaiming $35 as the level that invalidates the downtrend.
All get points. The issue, though, is that the warning about volatility, the potential for big corrections, it feels a little detached from the main bullish call.
Okay.
The idea of a patient investor needs to be anchored more strongly in those technical levels. I mean, what does patience even mean after a stock has had such violent swings?
So the weakness is that there's no bridge between that insane 540% move and this slower consolidation theory. We need to define the boundaries of what that patience looks like.
Exactly. Strengthen the link between the volatility risk and the technicals. Use that $58 high not just as history, but as a key psychological reference point. Frame this consolidation not just as a pattern on a chart, but as a test of the market's conviction after that huge speculative run-up.
And that framing helps justify why the patient investor is the right kind of investor for this stock.
It does. It reinforces that whole smart money idea. When you talk about the $35 key watch level, you need to clarify its significance in relation to the $58 peak. I'd suggest framing the current price, say $26 to $28, as the high-risk, high-reward entry point.
And contrast it with the ultimate goal of retesting 58.
Precisely. Could we map out that journey more clearly?
Yeah, how would you do that?
Emphasize that recovering $35 is just the intermediate step. It's the confirmation of stability. It's the market signaling it has digested the volatility. But clarify that retesting $58 is the ultimate confirmation that the secular bull run thesis is fully intact.
I like that. It gives the investor a clear, phased roadmap, specific benchmarks to measure conviction and risk, instead of just being told to wait abstractly.
It gives patients a defined timeline and tangible milestones to watch for.
That's incredibly useful. It turns the analysis from a static verdict into a dynamic investment strategy.
And that level of strategic detail is what separates a good report from a truly excellent one.
Well, this has been fantastic. For what's already a very strong analysis report, we've identified 3 key opportunities.
Yes. First, really deepening the context around that 150-plus qubit threshold, grounding it in tangible applications. Second, structurally integrating the $600 million cash pile as a direct defense for that 100-time sales valuation.
And third, sharpening the volatility narrative to really connect that $58 peak with the current $28 base building phase, giving that patient investor clear, benchmarked goals.